Hello, welcome to the paid weekly recap for the week ending May 16th, 2025. I'm Keith Harwood, CIO of Yellow Tunnel, also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel, and also the creator of the artificial intelligence used in the predictive AI for dynamic markets system. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and or the team at Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. If you need more time with the disclosures, please go ahead and pause the video now. Otherwise, we'll get into the market recap for this week. First things first, we got the 10-year yield. After the US-China trade relations seem to be improving, we had a bit of a rise in the 10-year yield. Now, of course, over the weekend, we had a downgrade from Moody's on US debt, and that's going to shift the 10-year yield again. However, at the end of the day, we're not seeing 10-year yield up to that 4.65, 4.7, 4.8 level that starts to create concerns over major inflation. We're also not seeing a lowering of yield that would normally go with concerns over an economic recession. All in all, this is kind of that happy medium, what they call the Goldilocks market to me, where we're staying fairly range bound, fairly comfortable in this range, and allowing the market to just digest the current conditions without having overly aggressive concerns over either a recession or inflation. And a lot of this does have to do with the US-China relations. And speaking of that, we did see a spike up in the markets on Monday. So Monday we had a big spike, got through the 200-day moving average, the 100-day moving average, the March 25th high, about everything that you could think of that could have been causing resistance, we gapped above. This is great from a technical perspective. It sets up a market that looks like it wants to get into a 590 to the all-time high range, 590 to 613. Now that Moody's downgrade may pull us back down below the 590 level. That could cause some little concerns over a short-term top. But at the end of the day, ever since the lows were made on April 7th, this has been a broadly bullish market with shallower and shallower dips. So we had the major spike on April 9th and then a dip. And at that time, because of the market dynamic that we had and the massive movement we had, this dip was big on a long-term perspective. On the short term, it didn't seem all that grand relative to 10% in one day, but it was still a dip that was meaningful. From that point on, we had a nice just trek higher for more than a week, a minor dip at the beginning of May, follow through here. We may be in for a minor dip here again. Maybe it turns into something more major if levels around 575 can't hold. But overall, this looks like a bull market. And when we've got a bull market, that's a great time for these bullish trades based upon technicals because it's looking for some stock picking elements. Tech leading the way. We gapped well through that 200 and 100-day moving average as well. We were closer to that level on Friday. Good relations with China, good for tech. Bluntly speaking, it's good for AI, it's good for semiconductors, it's just broadly good for tech. We're not seeing necessarily that leadership from like Apple, which is a bit surprising that Apple's been a bit slow to participate in this rally, but also allows for that much more room where we're not going out and just buying the biggest tech companies. It looks like the market wants to get participation from some of the lagging tech trade, such as semiconductors, and create that better bull market with broad participation. We do have an RSI over 70, both in tech and in the S&P. That's a little concerning. Again, we should be looking at a dip to start the week given the Moody's downgrade, but maybe that's just a viable dip opportunity. Time will tell and the market will tell. If people come in and start buying it back up, then it just turns back into that focus of every dip is a buying opportunity, even with a high RSI for now. Small caps continue to lag, didn't get to a 70 RSI, barely pressing through that 100-day moving average, still below the 200-day moving average, barely above the March 24th, 5th high. Really right now, small caps just haven't gotten much love. Now, this is a financially heavy sector, healthcare heavy sector. Healthcare has been hit by things like United Healthcare's now Department of Justice investigation. Although we did start to see some healthcare bullishness to end the week. And I'll note that when we talk about one of last week's trades. And then finally, the VIX down to 17 and a quarter. This is about as low as I expected it to get, frankly, given what we saw recently in April. It's hard to see the VIX get back down towards 13, 14%. We're right around that March 25th low. all of this kind of lines up pretty well. There should still be some fear and desire for hedging given the performance we saw just a month and a half ago. Does that mean that we're going to continue to move at 1% per day on average or more? Probably not over the long haul. Where that would really come into play to me is if we do start to dip back down. If we start to fall again, 17 is fully justified. 17 makes sense because of insurance, people wanting to buy puts to hedge their portfolio and make sure that they're defined risk and leverage in case of upside moves, or we get a fundamental input that creates bullishness or bearishness in this market to create an outsized return for an individual day or week or month. Right now, the question becomes, what's holding this market back from further highs? Well, maybe it's this Moody's downgrade. Maybe it's something out of tariffs, but right now tariffs seem to be going into the bull market case as opposed to in the bear market case. Now, talking through some of the trades from this week, first off, we had GE, and I'll come back to the late week rally, but GE on Monday spiked up with the market, had a nice return. And that meant that the half position that we had held over the weekend actually performed really well. So the stock was up 6.1% over the course of that 6 days, 6 calendar days, 4.5-ish trading days from midday Tuesday until the close on Monday. For this trade, we did enter at 865 and the exit was at 1430. So a 65% profit in 6 days. And this was a good return and a very good way to start the week. Especially with a bull market, it gets a little bit concerning on Monday after a big gap up. Are we going to really get that follow through the week? Well, we had it from every trade that we had last week. ABT started with some weakness. So some healthcare concern, a little bit of selling in there, but then between Thursday and Friday, we got right back to the highs of the range. 135 looks like some short-term resistance, but if that breaches, we could be looking at prices towards the 137 to 140 range. Now we have still half the position, but the first half of the position was closed on Friday for a solid 67% profit after a mere 2.5% profit in 3 days in the stock. That's the leverage of these options. It was a great run for ABT between Thursday and Friday to turn what looked like a imminent losing trade into a very solid winner. That's also the benefit of that defined risk of options. Knowing that we had that defined risk and the max we could lose would be the initial premium paid in the absolute worst case scenario. It allows us to stay in the trade, look for that potential upside return, that bounce back that we did experience Thursday and Friday, and generate a significant return on an even seemingly small move in the stock. GE, as mentioned before, just continued higher. So after the gap up on Monday that made a new high, we continued on Tuesday, continued on Wednesday, made a new high on Thursday, and then ultimately closed very close to the highs on Friday. Great trade for this stock, up 5.5% in 3 days after the rally on Monday. So from Tuesday's open till Friday's close, 5.5% return. That's a really good return for GE in just 4 trading days. And of course, that led to an outsized return on the options of 76%. Didn't quite get to that double in the 3 days. Perhaps GE can be part of the bull case on Monday and turn that into a 100% winner for the second half of the position. But all in all, a very solid trade for GE, and it's continuing to show some good upside momentum here. Doesn't seem to be phased at all by anything from the market. JP Morgan, along with other financials, gapped up on Monday. It's the same story there, of course, for almost everything, it seems. And then continuation once again. Little dip on Tuesday, follow through on Wednesday, follow through on Thursday. Didn't quite make a new high on Friday. Maybe again this week, maybe not. We will see. But overall, a great run in JP Morgan, just like these other names. 64% profit in that 3-day window. And then again, a 2.5% profit in the 3 days for the stock. So while the stock was up 2.5%, pretty solid. That can still generate a leveraged return in the options that we saw, 64% for those 3 days. A very solid trade for the paid system. So all in all, we had one trade held from the prior week, booking a 65% profit, 3 solid new trades for this week, each performing between 64 and high 76%. So a very good week for paid, very good week for the system. And we also had a great week in our live trading room talking through other ideas that were coming up, whether it was earnings such as Walmart or looking at it, a number of different, in Cisco and a number of other trades just on this potential for market opportunity. We talk every morning at the morning bell from 9:15 till 10:15, 10:30 Eastern time, and at the closing bell from 3 to 4. If you have questions about the paid system, about any other individual trades, what AI is predicting for those trades, I do urge you to jump in that live trading room. And also make sure you're keeping an eye out for new entries because we'll have some closing trades on Monday and new entries on Tuesday. It looks like we should be looking at 4 new trades on Tuesday. So a little dip in the market may actually benefit that much more for some of those new entries to get a little bit better price. As always, you can contact myself or Vlad, Keith at yellowtunnel.com or Vlad at yellowtunnel.com with any questions, comments, concerns, anything you want to talk about with regards to artificial intelligence, options, paid or otherwise. Always feel free to reach out. We make ourselves very available. And if there are any questions, we are happy to answer them. Thanks again and looking forward to hopefully another great solid week of trading this week. The AI says it's a good time to go, so we'll see if the market follows suit. So thanks again, everybody, for being a valued member of the paid system. And keep an eye on that inbox Monday, Tuesday for new trade closes and trade opens. Thanks again.